Hi, this is Al Brooks, and today is Friday, January 3rd, 2014. I hope everybody has a very happy and profitable year. When the market is at a possible transition point, I like to create a small PowerPoint to explain my thoughts, and we're probably very close to a transition in the market now from a strong trend phase and into a trading range phase, which could possibly last all of 2014. I have a couple of websites. One, brookstradingcourse.com, where I sell a 27-hour video course on learning how to trade using price action. And then I have a second website called brookspriceaction.com, where I have a daily chat room. I've also written a number of books about trading. Here's what I want to talk about today. This is the monthly Dow Jones industrial contract, and the market has been in an exceptional trend for about 5 years, and we're presently breaking out above the top of the channel. We had a high here, a higher high, and now another higher high, and we're having a bull breakout above a bull channel. And 2 chances out of 3 it'll fail, because that's what typically happens. Whenever you have a bull market and then a bull breakout above the top of the market, 2 chances out of 3 the breakout will fail and the market will return back into the channel and usually test some support level. Here we have a trend line which I do not have drawn in, and one possible target would be the bottom of this trend line. Also on the monthly Dow chart, you can see we have a high, a higher high, and a higher high, and a low and a lower low. So the Dow Jones industrial contract is possibly forming a large expanding triangle. The target when an expanding triangle reverses is the bottom of the triangle. At the moment, I think that's not likely to happen, at least not for many years. And that's not what I'll be talking about today. Here's the monthly E-mini, and we had a high, a lower high, and a lower high here in the form of a wedge. And a wedge top and a lower high, to me that was a reasonable topping pattern. The initial target would have been the bottom of the wedge down here. The bears would have wanted a breakout and then a measured move down, which would have taken us down here. The bulls would have been happy if the bear breakout resulted in a double bottom with this, and then a bull breakout and a measured move up. Instead of the bear breakout, which happens 2/3 of the time, we have a bull breakout. And when you have a bull breakout of a wedge top, the market typically goes up for a measured move and then has a more substantial correction, maybe 10 bars, 2 legs. 10 bars on a monthly chart is about a year. So we're very close to the measured move target. When we get there, the market may start to correct for 10 bars, 2 legs, sideways to down. It could simply be sideways. Anyway, 10 bars on a monthly chart is about a year. You can see the market was up very strongly here and then corrected for about a year and a half. It was down very strongly here and corrected for about a year. Up very strongly here, corrected for about a year. We're up very strongly here. When the market is moving quickly like this, the bulls and the bears agree that the price is too low, and it's racing up to a price level where both the bulls and the bears feel the price is fair. Right now we do not have enough bears willing to sell, and the market is moving quickly to find a price level where the bears feel the price is fair and the bulls feel the price is fair. And this is what happens when both the bulls and the bears like the price. The market goes sideways. All right? So that's what the market is in the process of doing. It's racing up to find an area of agreement between the bulls and the bears, an area of confusion. The bulls will buy and buy more as the market goes down. However, if the market goes up, they stop buying. If the market goes up, the bears think it's fairly priced in the middle of the trading range. If it goes up more, they think it's even better for them, so the bears sell more aggressively. The bulls stop buying, the market comes down. And at the bottom of the range, the opposite happens. The bears think the price is too low to sell, the bulls think it's a great price to buy, and the result is something like this. It just keeps going up and down, forming a trading range. Trading ranges can break out in either direction. Here we have a bull trend and a trading range and a bear breakout. Here we have a bull trend and an attempt at a trading range, and we got a bull breakout. This is a weekly chart of that same E-mini. And again, you can see the wedge. Here's the first push, second push, third push, and the very strong bull breakout. And then after this very strong phase, we're starting to get deeper pullbacks. So this is probably a channel phase. So this is probably a spike and channel trend. Channels typically evolve into trading ranges, testing near the bottom of the channel, here, here, or here. So this probably will test down to the bottom of the channel, somewhere down in this area, 1600, over the next year or so. Again, here is that monthly channel, 1, 2, 3. This is a weekly chart, right? But this is that wedge top attempt, 3 pushes, 1, 2, 3. And we're getting the bull breakout. Measured move up takes us to 1863. We're right now at 1825. We do not have to reach the measured move projection. We could turn down from below. We could get above it and turn down. Or it can be exact to within a tick or so. So we have a target just above where we are. And there's something else very important about this chart. There are several ways to draw channels. This red line drawn from this low to this low. If I create a parallel and drag it up and anchor it here, you can see the market broke above the top of the channel. I have a green channel here, steeper channel, using these two lows. If I create a parallel and drag it up here, trying to contain all the price, you can see that we are just above that green channel top and starting to turn down. We also have a bottom of the channel here. Every trend line is a potential bottom of the channel. And then here, I don't have the daily chart in this presentation, but there's a daily channel here, and we're at the top of the daily channel. So for me, what I see is several ways to draw channels, and every way that I draw them, the market is at the top or just above the top of the channel. And when that happens, typically the market, 2/3 of the time, starts to test down to the bottom of the channels. I don't have the daily channel drawn in, but it would be using these 2 points. The weekly channel, the blue line is the closest trend line, so that's a target. The green line is another target, just above 1600, and the red line is a final target. We will almost certainly fall to the bottom of the red channel. However, we may not get there for years. Right now, near term, over the next year or so, I think the green line is a more likely target, 1600, 1650. Also, we have the spike and channel up here. These lows are targets, this low as well, 1550, 1650. So to me, it looks like, based upon the channels on the weekly chart and this spike and channel pattern, that the market will likely test down to the 1600, 1650 area sometime over the next 15, 20, 30 bars, which would be next several months. And for a final slide, I want to go back to the monthly E-mini chart. Now, I believe that we are in a trading range. At the moment, I think we are in a trading range. Obviously, we're in a very strong bull trend. Anyone can clearly see that we're in a very strong bull trend. However, back here, if you look at this bar right here and ignore everything to the right, the market was in a very strong bull trend. However, look what happened over the next 10 bars. It went sideways. So even though at that bar right here it was in a strong bull trend, it was also going to be part of a trading range. When you look back at the chart and you say, where was this trading range? You'd circle this whole area, and that would include that bar. So that bar, although it was part of a strong bull trend, it was also ultimately part of a trading range. The same with here. Very strong bull breakout. And at this point, you'd say, well, it's clearly a strong bull trend. How can you possibly talk about a trading range? However, today, when you look back and you say, what was the market doing here? You'd say it was in a trading range. And you might even include this bar as part of the range. So very often when the market is in a very strong bull trend, it's also in a trading range, even though you don't know it at the time. The same with over here. Strong bull trend here, strong bull trend here, trading range. Strong bull trend here, still part of a trading range. And I think that's what's taking place here. An exceptionally strong bull trend all the way up from here for 5 years, and now even stronger here. So a series of buy climaxes. Well, here, and then here, 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 and here. Whenever you have consecutive buy climaxes, the market usually forms a trading range that goes on for many, many bars. As a guideline, I like to say 10 bars, 2 legs, sideways to down. Sometimes it's just sideways, sometimes it's down. Anyway, here, strong bull trend, sideways for about 10 bars. Here, strong bull trend, sideways for about 15 bars. Strong bear trend, sideways for about 10 bars. Right? So here, very strong bull trend, exceptionally strong, probably sideways for about 10 bars. This trading range, about 150 points tall. This one, 100, 150 points tall. This one, 150, 200 points tall. So what do I think we'll have here? I think we'll have a trading range that is about 200 points tall, about 10%. The bottom of the range, 10% down. We're 1,800 now. 10% of that is 180 points. That takes us in the middle, 1,600, 1,650 area, right? I don't know that we're at the top of the incipient trading range yet. We may go up another 50 points or 100 points. However, I think 5 years from now, when we look back here, we will see the market going up and down in a 200-point range for about a year. So the point I'm trying to illustrate is that even when the market is exceptionally strong, as it is now, I think it's important to be aware that the market might also be in the early phases of a trading range, because the early phases of trading ranges are strong trends. And I think that because of where we are on the monthly chart, I showed the Dow Jones monthly chart being at a possible expanding triangle top, and I showed the E-mini monthly chart and weekly chart being at many types of channels. We're also very close to a measured move up based on the top of this wedge. All of those things are resistance, and when the market has an exceptional move up, a series of buy climaxes, consecutive buy climaxes without much of a correction, it usually has a bigger correction lasting more bars and covering more points. Again, a guideline, 10 bars, 2 legs, sideways to down. 10 bars on a monthly chart is about a year, and prior corrections were about 10%. A 10% correction here when the market is around 1,800 is about 150, 200 points. So I think that we'll probably begin very soon to enter a 150, 200 point trading range lasting about a year. Thank you for your attention, and I hope that you found this information useful. And again, I am Al Brooks, and today is January 3rd, 2014.